COVID-19 has been one of the biggest determinants of financial markets over the last few months. After the initial sell-off in the month of March, markets have basically come off the lows of March 23rd and it's off its highs of 2019. We think that in the immediate term, financial markets will focus on the following. Number one, it will focus on the fact that economies will start to reopen because of the number of cases peaking in both developed markets as well as Asian economies. And more importantly, the fact that economies will start to think about a 2021 recovery in the months to come. In current difficult economic conditions, we believe that central banks and governments will use whatever it takes to ensure that the economies and its people remain functioning. So we think that they will continue to stimulate its economies using fiscal and monetary means, and also to make sure that measures are put in place to contain a recurrence of the COVID-19 pandemic. In times of uncertainty, it makes a lot of sense for customers not to get in and out of the markets, because history has shown that pandemics provides an excellent opportunity to invest, especially when they recover very quickly and priced in economic recovery in the years to come. Our advice to customers is to stay the course, stay invested, and think on longer term in terms of the horizon, in terms of the way they invest in funds. In response to the very sharp deceleration in growth in the coming quarters to come, a lot of the central banks across the world have been very fast in instituting a lot of monetary and fiscal stimulus across the world. First and foremost, the Federal Reserve has come out with a major fiscal stimulus of a quantum of $2 trillion in basically amounting to close to about 10% of its GDP. Likewise, whether it is the UK or Germany or Japan, they have also followed suit with major fiscal stimulus and also been very vigilant in terms of cutting its interest rates to support its individual economies. We think that these swift measures that are put in place in a very short time span has helped to eliminate any form of credit crunch that we can see in the short term in credit markets. We view that in Asia itself, in the coming quarters, growth will remain weak. But having said that, we think that it is reasonable to anticipate a U-shaped recovery in Asia, simply because I think China is starting to come out of this fairly quickly, given the fact that some of the leading indicators like the PMI numbers are starting to improve, and therefore we think that because it's one of the countries that were the first ones to get impacted by COVID-19, it has also put in a lot of measures, especially both on the fiscal front and the monetary front, to ensure that the economy bounces back very quickly in the coming quarters to come. To elaborate a little bit about the China fiscal stimulus, I think it is far-ranging in the short term. I think that in the short term, you will start to hear a lot of news flow coming out that will basically target the consumer sector in terms of its tax cuts, in terms of basically cash vouchers to support the consumer spending in China. And I think that they will continue to cut the RRR rates as well to support the financial system and so forth. So I think that the kind of the first quarter stimulus that we've seen is not over. We do anticipate more stimulus to come apart, and therefore I don't think China is done in terms of making sure that the economy continues to grow over the next 2 quarters. Japan has also come up with a very aggressive stimulus package of close to about $1 trillion, an equivalent of about 20% of the GDP, to basically combat the COVID-19 issue they have domestically. And we think that they may continue to be very vigilant on the monetary stimulus as well. Our strategy this quarter is a little bit more cautious than the previous quarter in light of the issues that I mentioned early on, particularly in an environment where we think that growth in the next coming quarters to come could be softer than the previous quarter. We are cautious simply because we think that there could be a double dip in markets in the shorter term, and therefore we want to keep our powder dry to invest in those quality companies, especially those quality growth companies that are able to withstand any forms of deceleration in terms of the global growth that we anticipate in the quarters to come. We do believe that investors will be able to take this opportunity and invest in these kind of companies, and therefore we want to be able to participate in the downturn and have our cash available to invest in these companies.